Rosenberg is chief economist and chief strategist at Rosenberg Research. David, always good to see you. And I did want to start there with what we've been seeing in Bitcoin. We've talked a little bit about it before, but as we see this kind of marching higher and higher, you do hear that argument now of, well, don't you wish you'd bought it at 10,000? And even better if you got in at 1,000. And what if it goes to 1 million? But underneath all of that, of course, we need a base case. We need a scenario that makes sense for Bitcoin. Where do you stand on it?
Well, everything you just described in 3 words or less is greater fool's theory, that you're buying Bitcoin on the assumption that some bigger fool is going to buy it at a higher price. Question you have to ask yourself is, how do you value Bitcoin? It's not a stock. You can't do any cash flow analysis. What is the present value of the discounted cash flows for Bitcoin? And so when you say, oh, well, Bitcoin is gaining credibility, okay, as a means of exchange, fine. You can actually also use the Swiss franc as a medium of exchange. I don't see the Swiss franc going up or down 10, 20, or 30% on a daily basis. So right. I can see how crypto is part and parcel of the payment structure. I get that. Why, people are there saying, well, it's going to go to 400,000 because we're going to compare it to gold. Well, you come and tell me what is it about gold and Bitcoin that have similar properties, except for the fact that that gold is actually used in the production of electricity, and Bitcoin only absorbs an incredible amount, environmentally unfriendly, by the way, amount of electricity. So I'll tell you the truth. Crypto is here to stay. It has a function in the capital markets, but valuing it is next to impossible. So all you really have to do is look at the price and look at the chart, and you could see it's a massive price bubble. The chart itself is telling you that.
Mm-hmm. I want to turn our attention to what, we can argue are some other bubbles. And we've seen the role played by retail investor base, stocks talked up on boards like Reddit. It does appear that cannabis stocks are now moving on some of that, although we've seen, to be fair, we've seen this group move in double-digit up and down swings before now. It's a volatile group. But what do you make of the kind of, I don't want to say frenzy, but, the speculative nature of some of the trading that you've seen lately? What does it tell you about where we are with this market? Well,
I think you answered the question. It is an incredibly speculative market, momentum-based, tremendous amounts of leverage. People say that it's liquidity. It's about liquidity. And then when you ask people, well, define liquidity to me, and they give you a blank stare, it's just about this tremendous confidence that there's this tremendous momentum, and it's really turned into a bit of a casino. This is not, look, this is, I titled my reports, no market for old fundamentalists. You can be a long-term investor, and all this is just noise. But, what are these, the Reddit crowd is what? I mean, do you consider these people to be real investors, or are they just short-term speculators? And that's really what they are. So, if you want to trade the market, you certainly want to focus on with this band of retail investors with a lot of power, it seems, on a near-term basis. But look what happened with GameStop. You run the thing up and then you run the thing down, go on to the next thing. But these are momentum players. These are speculators. These are not real investors. And frankly, I'm an investor. I invest for the long term. So I'm watching them from the sidelines. They have no impact on my portfolio, that's for sure.
The things, of course, that will impact your portfolio and others are things like what happens to GDP, what the comeback looks like, what the reopening trade looks like. Let's just focus on GDP here. And ask the question, because a couple of the variables we watch really closely, David, they include, and I'll say vaccinations, moving better than we might have thought in America. Does that change at all your thinking around timing or strength of GDP recovery for that market?
Well, look, the vaccinations are improving off a pretty disappointing base to start off. And actually, I would say that when you weigh in, you have to make assumptions as to what the take-up is going to be. Then you have to make some assumptions as to how frustrating it's going to be as these mutations take hold. It's not clear to me that we're going to get to herd immunity at the time that the market thinks we're going to. The market thinks that we are going back to normal and herd immunity by the third quarter. And look, we're going to get there. There's no question we're going to get there. Even the 1918, 1919, 1919 Spanish flu, it ended in a different way. This will end. I think it's going to end in 2022. That's when I think it's going to end. So it will end. I just think the timeline the market's got priced in right now is a little too hasty. And even more so in Canada, where it's clearly going to be a 2022 scenario. And what that's going to mean is that you're right. Well, when it comes to GDP, what's the vitality in the economy right now? And I'd say the same in the U.S. as in Canada, even though we're further behind. What is the vitality? Two things. The vaccines and policy stimulus checks. That's it. The U.S. economy, if it wasn't for all those stimulus checks last year, GDP wouldn't have been down 3.5%, Amanda. It would have been down 10%. So that's the extent to which we need all this policy stimulus. And you're quite right. It's only insofar as it means for GDP and earnings, insofar as we get to the other side of the mountain, and we're going to get there. But, the view in the markets is that it's going to happen by the summer. I think that's far too early.
So then that gets us to that kind of reopening trade made up of those players that have been directly affected. Are you interested at all in playing in this space and trying to get either the timing or just knowing you're buying at a weaker spot today than we expect, once normal does happen? Would this be a group that would interest you?
Well, it's not a homogeneous group. I mean, it's a great question, not a homogeneous group in the sense that, would I want to buy the airline stocks? No. I wouldn't. I still think there's just way too much uncertainty about what the demand outlook is going to be. Don't forget that these airlines derive a lot of their revenues from foreign travel. And so, sure, we could have U.S. reopen, Canada reopen, but if Europe doesn't reopen, I mean, it's not synchronized. So you only make so much of your money in the airlines on domestic travel. So the non-synchronicity of what's happening in terms of the vaccines. Not every country's coming out at the same time is going to complicate that process. Restaurants, the same thing. I don't think that they're going to be operating at full capacity as early as what's priced in. So I don't like one idea reopening stocks, but the way I would play it and the way I am playing it is through the banks. Financials are a diversified way to play whatever recovery we're going to see. And I would say energy is another great way, an undervalued way to play the recovery. Those are the two main components of the reopening trade I would emphasize, energy stocks and financials on both sides of the border.
All right, we've only got 30 seconds here, and it's a longer question than that. But obviously, we're seeing earnings roll in. In terms of beating expectations, if that's the metric we want to use, the quarter looks good. But overall, when you look at the profit growth of S&P 500 companies, does it justify the levels we see as we look at stocks?
No, not at all. I mean, this has all been purely multiple expansion. It's again, just a game. When was the last quarter you saw where earnings came in below expected? Every single time we go through earnings season, it's the same thing. Over 80% of the companies are beating. Over 80% of the companies are beating. Over 80% of the companies, they're all, because the analysts lowball the estimates, companies beat them. But actually, when you're taking a look at earnings, where they were first forecast 2 years ago for the fourth quarter, we're infinitely below those numbers. And yet the market's up 50%. So it depends on what you're using for your benchmark. If you go back to when fourth quarter earnings estimates were first released 2 years ago, we are well below those levels. Market's up 50%. Why? Multiple expansion. Why? Because of where interest rates are and the Fed's balance sheet expansion. And that's the ongoing story.
David Rosenberg, always good to get a dose of reality with you. Appreciate your time. David Rosenberg of Rosenberg Research.